we'll just call it on 7/31. Okay, so that's the day that you want to put into your think back date right here. So we'll just go back to 7/31. All right, that's the day it triggers in, and that's the day that you're going to be paying the price for the option. So let's scroll down and find the September option, which is this one here. We're going to open it up, and then we're going to scroll down to the 326 or 325 call option. So the strikes are in this column here. We're just going to go all the way down till we get there, right about 325, 326. You can see that there's not quite $1,000 difference, maybe a $600, $650 difference. So let's buy the 325 option. It's actually, yeah, about $600 or $700 difference, but actually it's less than that. It's $1,016, $1,016 versus $1,081. So I'd rather buy the one that's a little more expensive. We'll go with the 325, slightly more in the money. All right, and I'm just going to click buy. I'm going to click on that, and you're going to see that it puts it down here. Actually, let me get rid of these other ones. And then I want to change the quantity just to 1, because I'm only interested in learning what one option will make at each target. All right, so this is really cool. So you could see that the price was approximately $10.78. So that's $1,078 to control 100 shares of a $326 stock, which would have cost, $32,000. We're able to control 100 shares with a little more than just $1,000. And that's the most that we're risking, but we're really not risking that, because if the price were to come down and stop out, there would still be value on the option. It wouldn't be the full amount. So we'd sell the option back and recapture some of the premium. So even though the option is costing us $1,078, it's really not, because we're never going to hold the option to expiration unless it's just winning, winning, winning and still going. We might hold it, or we might roll it over, sell it, and get another option out. But usually I'm more of an advocate of just getting an option with plenty of time. So you could look at the trades and just try to pick an option that's, maybe 2 or 3 times longer than the average hold time, and you should be good. I would say 3 times longer than the average hold time, and you could basically just look at the charts and see for yourself how long these trades last. All right, so when it gets to target 1 is when you want to see what that option is worth. So it doesn't really get to target 1 until this day here, and that's on the 5th of August. So this is where it gets fun. All right, so we're just going to estimate the date, because it actually gaps through target 1, and we're going to be exiting somewhere in this bar here. And this simulated test is based on the bar close, the option price of when the bar closes. So it's not going to be perfect, but it still gives us a really great idea of how this works. So let's just choose the 5th. In fact, let's choose the 4th, because that is almost at the target, and it closes like just a few pennies below the target. All right, so what's the option worth on the 4th of August at the close? We've got our option here. All we have to do is put the date in right here, which I already did, August 4th, and we could see that it's worth $160. So $160 in just a matter of a couple days. We risked $1,078. We didn't really risk that full amount, as I explained, and we made $160 profit, or a little bit. We would have made a little more, because we would have got out the next day a little higher. In fact, if we put the next day in, it's actually $236. So somewhere between $236 and $160. Let's just use the conservative number, $160. So how much is that on a percentage basis? It's really easy to figure out. Pull up a calculator and just put in your profit of $160 and divide it by the price paid for the option, $1,078. And it ends up being almost 15%. So that's a 15% return in a few days. And that's assuming we're risking the full amount, which we're not. So again, this is actually, we probably made a lot more than what we're really risking in reality, but just as a basis to let you know how profitable this is. Incidentally, if you can make 15% a year, you have a career on Wall Street where you can make, a 6-figure, 7-figure salary. But this is 15% return on a single trade in just a matter of days. What about Target 2? Target 2 gets there on the 6th, a couple days later, and it actually closes above. So again, we have to kind of simulate what that return would be. But let's just say we get out at the end of the day or somewhere in between, just to give you an idea. Again, with the Think Back tool, on the 6th, it's actually worth $422. So if we get out with that $422 profit, once again, just divide the profit, 422, by the cost, 1078, and it equals 39%. That's a 39% return if we got out a little bit above the target. So we're probably getting out a little, lower. Maybe it's going to be 30%, 15%, 30%, and then of course target 3, which nearly closes right on the money here on the 10th. Well, let's just put the 10th in. And we could see it's $440. So, almost the same, because from here to here is not that big of a difference, and maybe you lose a little bit on some time decay, and there might have been some implied volatility. Something that affected the option price only gave $440, but still $440 in just a week or two. I mean, that's a nice return, right? 440 divided by 1078 equals, that's a 41% return in just a week or two. And if you can make that on a trade every single time, you could become wealthy really fast. But as I'm going to show you shortly, these trades will often make far better than this and will get you into the triple-digit returns, over 100 and sometimes 200% returns on a single trade with minimal risk. Simply amazing way to use a strategy. So it doesn't have to be perfect. The point is that it makes double-digit and often triple-digit returns on a simple directional trade. And that is how you trade options with the Counterpunch Express setups. But let's look at some other trades. So you can see that, first of all, the primary trade happened here. If we turned off the add-ons, the primary trade happened here. And so that would have been like a 313 or a 312, maybe a July or August call option, because that happened in June. And look at how much bigger that trade is. Remember, Counterpunch is dancing with the market, right? It's also getting long on a downswing. And you have possible short trades that cancel and instead stays long. Look where the stop is. Remember, we moved our stop down a little further. It held. And then when it got to target 1, it pushed up and started trailing the signal line. Now you can trail other methods too, but that's a simple way to do it. They got to target 1 all the way over here. Look at target 2. It might get to target 3. Who knows? If this stop holds and it goes higher, it could happen. In the meantime, you had another trade. This one in July. So you would buy an August 311 or 312 call, a completely different trade than the one prior, different size, hits target 1, and that's going to probably stop out on the trailer right in this area here. Even though if you weren't trailing, look how accurate target 3 is on that trade, all the way to here. Pretty amazing, isn't it? And that's right where it turned down. And then, of course, this trade, a lot smaller. Volatility change, the setup change, also accurate. Totally different trade, totally different size. Look at target 2 on the first trade and how accurate that one was before pushing lower. All 3 with accurate targets.